Hi, welcome back to Solution in YouTube channel. In today's video we will learn about present value. Present value is the current value of a future sum of money or stream of cash flows given a specified rate of return. Future cash flows are discounted at the discount rate, and the higher the discount rate, the lower the present value of the future cash flows. Determining the appropriate discount rate is the key to properly valuing future cash flows, whether they be earnings or debt obligations. Present value is the concept that states an amount of money today is worth more than that same amount in the future. In other words, money received in the future is not worth as much as an equal amount received today. Receiving $1,000 today is worth more than $1,000 5 years from now. Why? An investor can invest the $1,000 today and presumably earn a rate of return over the next 5 years. Present value takes into account any interest rate an investment might earn. For example, if an investor receives $1,000 today and can earn a rate of return of 5% per year, the $1,000 today is certainly worth more than receiving $1,000 5 years from now. If an investor waited 5 years for $1,000, there would be an opportunity cost, or the investor would lose out on the rate of return for the 5 years. Another important aspect in present value is inflation. Inflation is the process in which prices of goods and services rise over time. If you receive money today, you can buy goods at today's prices. Presumably, inflation will cause the price of goods to rise in the future, which would lower the purchasing power of your money. Money not spent today could be expected to lose value in the future by some implied annual rate, which could be inflation or the rate of return if the money was invested. The present value formula discounts the future value to today's dollars by factoring in the implied annual rate from either inflation or the rate of return that could be achieved if a sum was invested. The discount rate is the investment rate of return that is applied to the present value calculation. In other words, the discount rate would be the foregone rate of return if an investor chose to accept an amount in the future versus the same amount today. Let's see what is the formula for present value. FV stands for the future value that is supposed to be received or paid in future. R is the rate of return or discount rate to be used in the calculation. And N is the number of periods. Let's take some examples. Example number 1. Assume that you want your son to go to college 10 years from today, which has a college expense of $50,000. There is a bank offering an interest rate of 12% per annum for investment. In order to reach $50,000 10 years from now, how much you will have to deposit now? The amount for investment that you need today is the present value of $50,000 after 10 years. Let's find out the present value of the $50,000 payment to be made in the 10th year. So we have the future value equaling $50,000. We have number of period equaling 10 years. And the rate of return is 12% annually. Putting the values in the present value formula, we get the present value of $50,000 equaling $16,098.67. This means in order to pay the fee for your son's college after 10 years you will have to deposit $16,098.67 today at 12%. Example number 2. Assume that you have won a lottery. The organizer of lottery offers you 2 options. You can receive $2 million 5 years from now, or you can have $1,450,000 today. You can use the present value formula to find out which option is better for you. Assume the required rate of return in market is 8%. Now we will just put the values in the formula to find out the present value of $2 million. The present value will be $1,361,166. So with the help of a simple calculation you can see that taking $1,450,000 today is better than to receive $2 million after 5 years. If you have learned the concept, please hit the like button, and don't forget to subscribe for new lectures. You can always ask questions in the comments if anything is still unclear about the lecture. See you in our next video. Take care.